Hello, Wealth Whispers, and welcome to the Beginner to Intermediate Stock Market course. By way of introduction, my name is Sandesh, and I'm a 24-year-old stock market investor, social media influencer, and entrepreneur from Dublin, Ireland. When I first started investing at 18, I was clueless. I was emotional, financially illiterate, and working for minimum wage to make ends meet. This conservative mindset lost me all of my savings in the stock market. But now, at 24, I've accumulated over $14,000 in the stock market in a single year. I now invest with a structure. I'm now on track to outpace the S&P 500 market returns this year. So how did I do it? Well, it's simple. I spent weeks rectifying my wrongs, months studying what professional investors did right, and years putting it all into practice. Essentially, this course covers all of my learnings from the past 6 years, my simplified approach to investing, and my secret tips to become financially free in 12 months or less. So who does this course apply to? This course applies to all and any beginners that want to learn the fundamentals of making money in the stock market. To any intermediate investor that requires a simple yet effective system to investing smartly and not hard. You may wonder what you'd be getting with this course. So let's check the table of contents. Through this course, we're going to cover 6 key topics that you need to know as a stock market investor. First of all, we're going to go through the basics. What is a stock market? How does it work? What's a broker? The type of broker options and the different types of brokerages that you can use as a new investor. Number 2 is we're going to go with the investment strategies. So within investing, we have 2 types of strategies. You have your fundamental investing and you have your technical investing. So as a beginner, fundamental analysis is essential to investing and making money in the stock market. So we're going to cover fundamental analysis. We're going to quickly just talk about technical analysis, but we won't be covering that in much depth in this course. We're going to also be talking about behavior analysis, dollar cost averaging, and dividend analysis, my favorite. Next, we're also going to be covering a thesis. So what is a thesis? What is my investment thesis? And what are the investment theses of popular investors that you can accumulate and learn from? Number 4 is we're going to be talking about the different methods to buy stocks. Within stocks, you have different types of orders that you can place. So you can do a market order, a limit order, a stop order, and a stop limit order. We're going to be covering each one of those in detail in this course. Next, we're going to be talking about the big topic that I'm sure a lot of you are here for, which is your fundamental analysis. How do you find winning stocks? How do you read financial statements? How do you value what is a good company and when is the right time to buy? And also, how do you research CEOs to know that the company you're buying won't go bankrupt in the long term and it'll sustain? Essentially, I'm giving you my full fundamental analysis process, step by step, and I'm going to also give you the files that I'll be using in this video or in this course for you to use later on. And lastly, as a special thank you for getting this course, I'm also going to give you the bonus modules. 2 things that most people don't teach you as a beginner investor, which is how to invest if you're starting for the very first time and how to pay your stock taxes. Essentially, this course is designed for a universal platform. So a lot of this material that you find may or may not relate to your particular country, but it'll give you a very strong basis for you to research some of this information for your respective country. But what I can promise you is that we'll be looking at US stocks majorly in this course, essentially because US stocks typically give you the highest rate of returns. They have less restrictions on how much a stock can trade on a particular day, and it's very quick to make your first $100,000 through the US stocks compared to other trading platforms or different stock exchanges. So that's what you'll be getting in this course. Hopefully you're looking forward to it as much as I am, and I will see you in the next module. Welcome to Module 1, which is the basics of the stock market. Now, in this module, we're going to be talking about what are stocks, how does it work, the types of brokerages, and some of my personal favorites that I would personally use if I were to start all over again. When getting into the stock market, a common flaw that investors don't teach is understanding the basic terms you'll hear quite often, either in the news, in fundamental analysis, or in various business conversations. So let me run you down how the stock market actually works first. So the stock market is a platform where companies of various natures publicly list shares of their company for the public to purchase. Typically, the company that is listing itself in the stock market is known as a stock. When a stock lists itself on an exchange, it is essentially dividing its overall shares and allocates a percentage of total ownership to public investors and retail investors. So when public investors buy shares on a broker, this will push the stock price up in the overall market. When the same investors sell shares on a broker, this will push the stock market price down in the overall market. So typically, the buy price will be slightly higher than the current market price, whereas a sell price will be slightly lower than the current market price. This will entail the direction of the stock when an investor buys or sells. There are also various exchanges, investing platforms, etc. that you can find stocks on and trade the stock respectively. For example, if you live, let's say, in America, most stocks trade on the NASDAQ exchange or the New York Stock Exchange. To buy stocks in America, M1 Finance, eToro, Moomoo, and Webull are all some of the best investing platforms that I would recommend. In India, Upstox or Zerodha are some of the best apps to use. And for Europe, Australia, and other international countries, I personally use eToro, as I find the user interface is quite easy to use, and I love the online classes that they provide each week. And no, this is not sponsored by eToro at all, so it's just my personal opinion. But if you would like to give eToro a try, I will leave a link to the platform below, and feel free to start experimenting with how the platform works and if that suits you. Other options also include Trading 212 and Interactive Brokers as well. Lastly, it is important to understand the various types of brokerage accounts that you can avail depending on the time you possess. A brokerage account is essentially your investment account that you will use to hold your stocks in. So here are the 5 main brokerage types that you can avail. So your first one is an individual account. The second one is a joint account. Third is a custodial account. The fourth is a retirement account within which you have your Roth IRA. And the fifth is your 401k. Essentially, both are for your retirement. So an individual account is an account that is under your name and your control. You will be making the choice to buy and sell stocks, and you will also be paying taxes on capital gains. This is personally what I use just because of the control that I have and the confidence that I have in terms of investing stocks. But this isn't what I would recommend to start off with if you're a beginner. Next, you have your joint account. A joint account is an account that is shared between 2 or more investors, essentially. This is ideal for married couples that plan to share mutual control over their investment portfolio. This might be a risky account to open up as a first-time investor, but for more experienced investors, this can be used as a mutual income account. This is ideal for someone that is looking to share control rather than have full ownership of an account. So if you want to share an account with your father or your spouse or your brother that's above 18, then a joint account is ideal in that case. The third is a custodial account, and this is ideal for those that have children. So this is ideal for a parent who would like their child to get into trading at an early age with minimal risk. In most countries, these accounts are tax-free up to a certain amount, and then taxed at a rate that is lower than a working class employee. So there's huge advantages to using a custodial account. But the only major disadvantage is that by starting early, by the time your child reaches 18, their investment account will be seen as an asset, and this could significantly reduce their likelihood of availing corporate funding for their tuition or any other institute later in their lives. So with that being said, this account is likely available in most international countries, but do search for the best options in a country near you. Lastly, retirement accounts are applicable for any working class employee. In the US, the 401k and the Roth IRA and the traditional IRA are popular choices. Essentially, the 401k will likely have an employer match over the IRA, whereas the traditional IRA allows you to pay taxes at the time of withdrawal, and the Roth IRA requires you to pay taxes up front and none at the time of withdrawal. So that's the key difference between a 401k and a Roth IRA. The 401k will make you pay taxes only at the time of withdrawal, whereas a Roth IRA will make you pay taxes up front and none at the time of withdrawal. So it's quite understandable that the 401k and the Roth IRA are not applicable in all countries. So some equivalent plans can be found on Google, but I'll share a few that I found from my research. So in India, the ADC, which is 80C, the Equity Linked Savings Scheme, and the National Pension Scheme are all viable options. In the UK, you have a Lifetime ISA and a SIPP. In Ireland, you have the PRSA, and in Australia and New Zealand, you have the Superannuation Fund as well. So all in all, you will need to choose the best plan for you. If given the option, a custodial account will be the best starting point for getting into investing. However, I'm sure most of us watching this course are likely already over the age of 18. So essentially, you would need an individual account if you plan to trade on your own terms. If you are worried about the risk of making ill-informed decisions, a retirement account will be the best option for you. So this will all depend on your investing strategy and the amount of time that you have. So it's not mandatory to make your choice now in terms of what strategy or what account you'd like to take, but this is a good basis for you to understand what accounts you can choose from. So again, this will all depend on your investment strategy, but let's cover what the investment strategy looks like so that it gives you more context for you to choose the best account for you. So I'll see you in the next module. Welcome to module 2, which is investment strategies. Essentially, your investment strategies are the different types of approaches that you would like to take in terms of making money in the stock market. As I mentioned earlier, there's 5 that I personally see most people use, and I'm sure there's a lot more approaches out there, but I would recommend as a beginner, these are the 5 that you should likely look into because it's easier to make money, if that makes sense. So before I start this module, I wanted to also address that a lot of people fear the use of the stock market. It's important to state that stocks are not a form of gambling. So if you learn it correctly, it is an actual art that can do wonders for one's income status. You need to understand and apply these 5 strategies, and this is what will make you a master trader from a novice investor. So we'll be covering number 1, which is fundamental analysis. I'll also quickly mention a little bit about technical analysis, but that's more advanced, so we're not going to be covering that in more detail. But since you have access to the free Patreon, feel free to request it there or during our one-to-one calls, during any group calls, or during any videos, and I'd be more than glad to talk to you about that in more detail. Just to keep it simplistic, for now, we're not going to be talking about technical analysis in too much detail. Then you have your behavior analysis. You also have your dollar cost averaging, which is a very popular investment strategy that a lot of YouTube channels typically try and push onto investors, or they give context and then they try and push that narrative that it's one of the best approaches for most investors. But we'll talk about that as well. Essentially, you need to make that choice, but I'll explain to you in detail and you can see whether that works for you or not. And then we'll also be talking about dividend analysis. So let's get into the first topic, which is fundamental analysis. So fundamental analysis is essentially the process of evaluating a stock's intrinsic value by its quantitative financial statements. So while that's a broad term to define fundamental analysis, it'll make more sense as we go through later in the course. Typically, you use the financials of a company that the company will provide to you each quarter to assess the qualitative and quantitative value of the stock. So these financials will be later utilized in our analysis in the form of ratios. But just to understand this further, let's take a basic example here. So assume that there's a company named XYZ that is reporting their quarterly earnings. Your CEO is titled ABC, and you are expecting the company will beat on its top line and bottom line financials. So their bottom line is essentially their costs and their top line is essentially their revenue here. So to assess whether the company beats its estimates or not, a copy of their financial statements is made public on their investors page. And you can find this on any company's investors page. And based on these numbers, we'll be able to assess the ratios of that company. So if a company beats on its top line, which in financial terms essentially means revenue, and their bottom line, which again in financial terms means their costs, we can say that the fundamentals of a company is strong. And if they don't beat on the top line and bottom line, the opposite applies and we say the company is weak. So that's how you essentially define a fundamentally strong company. So we would need, in this case, XYZ to beat the expectations set by Wall Street each quarter. So this is a basic explanation of fundamental analysis, and it is essential for all investors' analysis. Technical analysis is the use of lines, candles, and indicators that helps understand the price direction of a stock. We won't be covering this in this course, but feel free to pop that in our Patreon community, and I'm more than happy to teach it there. So behavior investing is the use of human emotions and psychology in your investment process. A good indicator that traders use is called the fear and greed index. When the market is massively buying into the stock market, this index indicates that the market is greedy and now is not a good time to buy. But if the market is massively selling, this index will fluctuate towards the fear side, indicating that now is a great time to buy. So Warren Buffett typically uses emotions as a primary driver in his investing process. If a product or service has an emotional attachment to the customer, he typically tends to buy those type of companies. And if you think about it, his greatest investment that I see is Apple, and Apple has a moat, a massive moat or a strong competitive advantage. And most people are now emotionally attached to their phone. So that's how he typically uses emotions as a primary driver for his investing. So from this approach is where we got his famous quote, be fearful when others are greedy and be greedy when others are fearful. So be cautious yourself when using this approach. The next strategy is called dollar cost averaging. So dollar cost averaging is a more conservative approach to time intensive investing. Essentially, you allocate a fixed amount of income each month for certain stocks and continuously invest into these stocks irrespective of whether the price fluctuates up or down. So I had typically undertaken this approach when I first started investing, and it certainly helps to build discipline. So this is certainly a strategy that I recommend for any new investors that is either watching this course or anyone that you are going to advise in the future. So the last investing strategy on our list is called dividend investing. Essentially, you invest into good companies that continue to pay you a dividend for purchasing a share of that company. So let's take an example to see how this works. Imagine you as an investor have $1,000 to trade and you decide to buy 10 shares of company XYZ, and this company is trading at $100 per share. Upon your purchase, you realize that this company will pay you a dividend of $1 per share that you own each quarter. So through this form of investing, along with the gains that you will accumulate with a price increase, you will also earn an additional $40 per year owning this stock. This is a wonderful approach to building passive income even while your stock is trading upwards in price. So while this approach has its pros, there is a massive con that we need to talk about. This con is known as the dividend trap. While majority of companies pay a dividend, these companies might not be necessarily good company, which means that if the fundamentals of a company are not good, as we discussed earlier, a company can continue to pay a dividend to their investors, but you will be trapped in what I call the stock market trap or the dividend trap. You will be trapped in a stock that will continue to decline in value. These are the companies that you need to avoid. So later on in this course, I will teach you my personal approach to finding good companies so you don't fall into the dividend trap. And to establish my approach, just to be clear here, I use fundamental analysis for initial research, I use technical analysis for price direction, and I use dividend investing to build passive income. Welcome to Module 3, where we talk about what is an investment thesis, my personal investment thesis, and the different types of popular thesis that you can use for your stock market journey. So when I first started investing, I was emotional, I was financially illiterate, and I lacked a structure to my investing approach. I followed the hype and eventually got burned. And I'm sure a lot of us have been in this boat as well. But since then, I made sure to rectify my mistakes, and it all started with finding an investment process that works for me. I call this set of rules as an investment thesis. Essentially, this is a set of criteria that you abide by in your investment journey. You only buy a stock if every criterion within your investment thesis is satisfied. Every famous investor that you know has one, and I'm sharing mine now. So my investment thesis is buy good companies, as we mentioned earlier, fundamentally good, don't overpay, and then buy it and do absolutely nothing after that. It's that simple. Buy good companies, don't overpay, sit and do nothing. It's that simple. By seriously following this approach, my stock selection, my research, and returns have greatly improved each year. So here's what you need to do. Find a famous investor that you believe in. Understand their investment thesis and see if it suits you. Mine is based on Terry Smith, but here's the two more theses that you can adopt. So one is, of course, the great Warren Buffett. He talks all about value investing, which basically means you buy a company based on its intrinsic value, which I will teach you later on. The second is Peter Lynch, and Peter Lynch talks about multi-baggers, which essentially means you find penny stocks or stocks that have a stock price of $5 or less. But nowadays it also, people consider $1 or less as a benchmark, but I consider $5 or less. So you find these sort of penny stocks and you hold on to them until they compound into large cap stocks. So whatever suits you, pick the investment thesis that you'd like to adopt. But whatever you do, make sure you have your ideal investor's investment philosophy in place first before you buy any stocks in the stock market. By doing this, it'll be a massive game changer. Welcome to Module 4, which is the different types of methods to buy stocks. So here we're going to be talking about market order, limit order, stop order, and then stop limit order. So by this point, you would have chosen your broker, understood how stocks rise and fall, discovered an investment strategy that suits your lifestyle, and have adopted a rule book that you will abide by. So the next step in the investment journey is to decide how to buy a stock. So within stocks, we have four types of buying options, which we call orders. You have your market order, you have your limit order, you have your stop order, and you also have your stop limit order. A market order is the ability to buy a stock at the price that it is currently trading at. In most cases, you'll be utilizing this sort of order when you make a purchase or sell shares of a stock in real time when the market is open. A limit order is the ability to buy or sell a security at a predetermined price. So this sort of order is ideal when you want to buy a stock at a particular price, irrespective on the timeline within which the order is executed. A limit order is the ability to buy or sell a security at a predetermined price. This sort of order is ideal when you want to buy a stock at a particular price, irrespective on when the timeline within which this order is executed. So just to understand this, let's take an example. If stock ABC is a strong company fundamentally, but is trading at a price that is above what you are willing to pay, you can set a limit order to trigger when the stock reaches the price that you are willing to buy. This can be today, this can be next week, this could be next month, or even next year, but the order will trigger when the price is hit. So I normally set price alerts for my stocks, as I have several stocks on a watch list that I like to look out for. But if you are certain on the stocks that you want to buy, this order will work best for you. So the next order is called a stop order. A stop order is a little bit more complicated to understand, but try and bear with me to see if we can get this here. A stop order is the ability to sell a stock at a price that you have set it to. This order is ideal for flash crashes and can only be executed when the market is open and not during market closing hours. So essentially, if a stock is trading at, let's say, $100 and you decide to buy it at $100, but you anticipate that the stock might crash and it's a risky investment, so you would set a stop order, let's say at $95, in order to reduce the amount of risk that you may face if you don't sell at that particular price. So if you don't sell at 95, but the stock trades lower, you're going to be holding that stock for a longer period of time, and you're going to be trailing down in terms of the negative returns that you get. So stop order, its essential purpose is to help mitigate that risk, help you sell at, let's say, 95, because that's the price you have set it to. You might book a $5 decline in value, but unlike other investors who don't set a stop order, you're not going to be bearing the brunt of, let's say, 15% decline, which might be $15 in this case. So essentially, this is good for flash crashes, and you're helping to mitigate risk on risky investments. Lastly, a stop limit order is a combination of both a stop loss order and a limit order. It provides you the ability to sell a stock if the stock price declines and the ability to buy a stock if the price inclines. So if you're new to investing, a stop limit order will be your best friend. So one additional topic that I wanted to mention here, and it's not super important, but it's very much good to have knowledge on, is called indexes. So essentially within the stock market, you have various sort of indexes, which are your guiding pillars to see how the stock market is doing on that particular day. For example, you have NASDAQ and the S&P 500. You have various sectors that are also indexes, and you also have mutual funds and ETFs. So I know we spoke a lot about the basics that you need to know, but just bear with me on this one. The final prerequisite that you will need to know are the indexes and how the market uses these indexes as pillars for the overall stock market. So an index is essentially, or an index fund, is a group of stocks from various sectors that aims to replicate the returns of the market. So within American stocks, the NASDAQ and the S&P 500 are two key indexes that you should constantly track if you're trading on the US stock exchange. So these two indexes are acting as two benchmarks of the overall stock market. And if you notice a decline in these funds, there's a high likelihood that your individual stock could also experience a decline in price to follow this market trend. The equivalent of the NASDAQ and the S&P 500, let's say in India, would be the Nifty 50, or in Japan would be the Nikkei. So in whichever stock market you are trading in, identify the top two indexes and continue to track their prices ahead of buying or selling any of your stocks. Well, folks, it's a moment that you have been waiting for. No, I'm not going to prolong this any longer. It's time for us to discuss three crucial elements of fundamental analysis that will get you investing from beginner to intermediate level. Now that we have the basics covered, I'm going to share my fundamental analysis approach from start to end for you to replicate or to consider for your analysis approach. So the three key topics that we will be covering here are, first of all, how to find winning stocks and how to gather this information to initially purchase. Next is to read financial statements. That'll help us to stay invested. And we'll also be looking at the valuations, which will essentially help us to understand what price should we be purchasing a stock at. So within this, we're going to be looking at two key metrics, which is the price to free cash flow and the intrinsic value. So let's get started. Okay, so being able to find good companies is essential when you want to start building up your returns for the long term. So this is what I do to find good companies. So step one would be to go to to this website called Stock Analysis. Essentially, this is a good platform, or it's a good database for you to find information about a majority of US stocks. So this website will list out all the stocks on the American market for us to assess. And on a side note, I prefer investing in the American markets, if I haven't said that already, just because of the long-term gains that you can generate compared to other markets. What we need to do here is first, we need to identify the industry that we would like to explore. So to do this, you click on stocks here. You click on by industry, and what I like to do personally is I like to filter by the last 3 years. Okay, so as you can see from this list, we can see communication services is an industry that has done well. So I'm going to take this industry to analyze. Okay, so as you can see, we now have a list of all the stocks that have contributed to this industry's leading performance. However, there are too many for us to assess. I think there's about 67 different stocks here. So one filter that I personally like to do is I like to filter based on the volume of the company. And we're going to keep the company name here as well. So what that allows us to do is to get an idea on what other investors are personally trading. So based on this, we can see there's now a multitude of stocks that are trading above 1 million. For example, you have Google, you have Meta, you have Spotify, you have Dash, and so on and so forth. So by clicking on this, again, we're going to get the topmost stocks that have been filtered. And from that, I'm going to take, let's say, Alphabet, just because it's a stock that we all know and one that I haven't assessed before. So let's take this one. Okay, so step one is essentially to understand what you identified. Since we all know what Alphabet does as a company, in most cases, we'll end up identifying companies that you might not have heard of. So one step that I personally like to do is I like to conduct a behavior analysis of a stock. In this case, we're doing a company that we all know about, so we all know Google and what it does. But for example, if you're taking a different company, you might not necessarily know what it does. So behavior analysis is essential to understanding what the nature of the company is, how do consumers perceive it, and does it have, most importantly, a competitive advantage, which I like to call a moat. So these are the 3 questions that I like to assess. So let's do that quickly here. We're on Google's stock analysis page. What I like to do first is click on profile. And that will essentially give me the company's description, which is kind of tackling the first question, which is what does the company do? So I quickly skim through this, and from this I can see that Alphabet, essentially it's present in multiple continents. It has multiple services such as Google Services, Google Cloud. It also has Google Ads, Android, Chrome devices, you know, the usual jazz of what Google does. YouTube, which is a big social media play, Google Photos, Google Maps, etc. It's also involved in the sale of apps and in-app purchases, so we get commissions from app stores and various purchases of that sort. It's also in Google Cloud, which is kind of the next future, the future prospect of Google and the next segment that it's really trying to monetize, just like any other major tech firm. Cybersecurity, database, AI, which is very much a buzz term that's being used in 2024. So that's quite enthusiastic. Essentially, you go through this entire description and you see what you like and what you don't like. For me, of course, Google is a great company. We all know it has industry-leading performance. It's quite heavily traded within this index or within this sector. But essentially, if it's a new company, you're going to be going through all of this and trying to understand what the unique selling proposition of this company is, because that's what's going to get you the most money long term. Okay, so now that we understood what the company description does, what I then like to do is I like to open up YouTube just to get an idea on what is Google. Just type in basic information on what the company actually is and how people are talking about it. So here I get a bunch of information on what Google is, the history on it, but just to be more precise, let's say feedback on Google services, for example. That kind of gives you a basic idea. Okay, this guy is happy. I'll probably go through this video to see what he's saying more about it, but he's selling Google Ads, which is quite positive. Also, what you'd like to do is you'd also like to say, for example, Google Cloud, and you just type in Google Cloud, you'll get a bunch of videos talking about, let's say, Google Cloud courses. So essentially what I see here is you don't have to go through all of these videos, but what you can see is that a lot of YouTubers are trying to sell the narrative of Google services or Google products. So that's quite positive for me because I see that 780,000 people felt like they had to learn Google Cloud. And a lot of people also, let's say if I type in Google Pixel, just to get an idea on their hardware, I can see that a lot of people are reviewing Google products. You have some YouTubers having millions of views on products like this. So essentially there's a positive narrative that's being derived from a lot of my searches, and that's positive for me in terms of seeing the stock holistically, which is in a good limelight. So another aspect that I personally like to do is I like to type in the name Google just to see what people are talking about in terms of news today. So for example, here I see that there's some negative news about Google. I see there's some positive news about Google as well. They're opening a new pub in Dublin, which is, yeah, drinking is too big in Dublin. So I don't know how I feel about Google opening a pub here, but this essentially will give you a little bit of idea of some of the investments and what's trendy. So I can see here as well, because I'm in Ireland, I'm in Dublin, a lot of the news is about Google Gemini. There's some negative news about Google Pay. There's some positive news about Google integrating with AI as well. So essentially what I do is I do this for about 5-10 minutes just to see the narrative that the media is being pushing in terms of Google. For me, I see it right now as a mixed bag. So I see a lot of positivity being shown on YouTube, but on, let's say, various other websites, I see there's a little bit of negativity that's being pushed through Google. So I'd be a little skeptical when it comes to identifying the moat that this company has, but that's kind of what I look for in terms of how consumers perceive it. So I'd say, just to conclude here, it's about 80% positive and it's about 20% negative. Okay, so for the last question is whether it has a competitive advantage, which is a moat or not. What I essentially do here is I search on Google for the market share that the company has within various segments that it is present in. So for example, if I would like to search, let's say, the global desktop market share of Google compared to other companies. Okay, so Google here has 81.95% market share, which is amazing compared to some of its other competitors. So that's very positive for me. If I also look at, let's say, the search engine market, I see that Google has 90% of the overall search engine market compared to its competitors. So that's also very bullish. And just to talk about this on a real term perspective, I know we're kind of talking about this hypothetically, but this was a major issue for Google recently, especially about a year and a half ago when ChatGPT integrated with Microsoft Bing. And essentially, Google had almost 95% of market share. It slightly dipped to about 90 now, and Bing slightly pushed up to about 3.72%, but it's still very bullish to see that Google holds 90% of the market share. So I can see from here that it's very positive holding Google. One other aspect I would like to see is Android market share. Just in general, because I like to know the hardware sector of Google is also doing very well, because right now we've seen the software side and we've also seen its primary moat, which is the search engine side. So just by checking the Android side or the hardware side as well, I'd be very satisfied with Google, just to see that it's a very polarizing company based on the customer sentiment, but it's also doing very well as a business and has huge customers in the first place for people to be pushing a certain narrative. So I see here that as of 2024, Android has 70% of global market share, which is great. It's the number one in the world. The iPhone follows up second with 58% market share. Essentially, 47% of former Android users say the iPhone has better user experience, yet a lot of them are still flocking to Android just because it's more cheaper than purchasing a phone that has, let's say, the iOS software in it. This is great news for me. Hardware looks like it's doing well. Even if it's not Google's hardware, it's Android hardware that is being utilized in a lot of other competitor phones and devices. So I'm very satisfied with this moat. This is a hefty moat that will not disappear over the long haul. So this is great. And this is a company that I would now like to research more on. So these 3 sub-steps will give you an idea on how emotionally attached consumers are to their stock that you are viewing and exactly what this company does. So speaking on that, now let's get back to the next segment. So now that we have a basic idea of what Google does and the 3 questions that we had answered earlier on, I want to start browsing the basic fundamentals underneath the overview tab here. So essentially, this is where we started off, but essentially the overview tab will give you a set of information, both qualitative and quantitative, about how a company is doing. So this is a synopsis or a quick summary that you need to know about what all of this information essentially does. So that's why you only see these figures and you don't see all the balance sheets, the P&L, and all of that jazz. So we're going to get more into it, but just from my initial understanding, I can see that Alphabet looks like a stock that has been trading for greater than 1 year. And I say that just because there's sufficient data to draw conclusions from. So there's beta here. You also have dividend here. You also have your PE ratio and your forward PE here. So usually for stocks that are new onto a stock exchange, that is, let's say it's been trading for less than 1 year, you won't have this data present. So the fact that Google has this is already great for me. It doesn't change my perspective at all, but it just is good to know that this company has been trading for a while and that I'd be able to analyze it in the detail that I want to. But anyway, let me just quickly explain what you see here so that you can understand the approach. So the market cap is essentially the number of shares that are in circulation multiplied by the current share price of that stock. So this 2.19 trillion is essentially the current market price, which is 176.79, multiplied by the volume, which is 15,621,215. So if you manually do that, you should get a figure of $2.19 trillion. So greater the market cap, the larger the stock is in terms of the organizational value. The market cap is great, but this is a volatile figure. This figure fluctuates based on the share price. So I don't massively use this metric in my analysis, but it's not a major deal breaker when you're trying to buy or sell a stock as well. So it's good to know, but it isn't the end all be all in terms of trading a stock. So the next is volume. The volume is the number of shares that are being traded by various traders. Then you also have your revenue, which is the TTM, which is the trailing 12 months. So this is a revenue for the last 12 months that the company had earned or declared as a part of their financial statements. Then you have the open price. So essentially the open is the price that the stock opened at during the last trading day. So the last trading day when I was recording this was a Friday. So the stock opened at $174.22 and it ended up closing at $176.79 on that same day. The previous close is essentially the last closing price for that stock. The days range will give you the range that it was trading between. So it opened at 174.15 and it closed at 177.06, between that range. Often there's a slight difference between the days range or the closing price and the after hours price. Essentially what that means is sometimes when a stock is off the market, it still is being traded using what we call leverage. And leverage is essentially debt. So I don't recommend trading debt. I personally don't use debt. It's more risky, but it also has higher reward as a part of it. But that's why you see a disparity between the 177.06 and the 176.75. It's because there is after hours being traded or traders trading post market close. That's that. A lot of this information is quite basic. It's just good to know. So now for some of the more important stuff. The first aspect that I like to draw your attention to is called the EPS TTM. And essentially this is the earnings per share of a stock for the past 12 months. So this ratio measures a company's share price, which is 176.79 in this case, to its per share earnings, which is the PE ratio, which also stands for price to earnings ratio. So if you take this share price and divide it by the PE ratio, that's essentially your earnings per share. So why this is important is because it tells you for every share that you buy, you're likely to get a 6.52 times earning on that share. So this is a good metric to know. Usually anything which is greater than 5 is really good. So it's very positive to see that the earnings per share here is 6.52. Occasionally, if either the PE ratio or the EPS TTM has the word NA written next to it, not applicable, that means the company has not been publicly trading for greater than 12 months. Okay, so the next important factor that we need to take a look at is called the PE ratio. So essentially, the PE ratio is known as a price to earnings ratio. You get this figure by dividing the current share price by its earnings per share. In this case, it's 176.79 divided by the 6.52, and that's how you get your PE ratio. Similar to the PE ratio, we also have another ratio called the forward PE, and it's calculated in the same way as the PE ratio, but we use this as an estimate figure for our earnings per share. The forward PE ratio will give you the earnings projection the next year, whereas the PE ratio is a current ratio that you use in real time, if that makes sense. So the ratio will predict where the PE ratio might be for this time next year, but essentially there's no guarantee of that, but it's a good metric to have in terms of understanding what the forward projection would look like. Normally, if your PE ratio is between 20 to 25, it's very robust. It's a very positive figure that the stock is very healthy, but it's also a really good time for investors to buy. So here we can see that in the next 12 months that the forward PE is between 20 to 25. So I like to keep this in mind when I analyze Google later on, but it's very bullish that I would like to now purchase Google based on this figure as well. Okay, so that's the forward PE and the PE ratio. The next important metric that I like to take a look at is called the dividend. Dividend is essentially the per share payout that the company makes to us investors for holding their share. And this is an essential factor for dividend investing that we had mentioned earlier on under the investment module. So essentially, Google is going to pay you 80 cents for every share that you hold, which is quite good because if you end up holding, let's say, 10 shares, which will cost you $1,760, you end up up getting $8 as return for holding Google each quarter. So that's really positive. And right now, early on, it seems it's very minimal. As you keep on trading and as you keep on holding Google, as you keep on accumulating more shares of Google, it's very positive that at some point you will earn enough dividend where you don't even need to take a look at the stock and automatically it starts compounding your investment portfolio. So dividend investing is very crucial, and it's something I personally like seeing as well. And the last figure that I personally like to take a look at is called the beta. The beta is essentially the degree of risk that is associated with a stock. There's not much to explain within beta, but essentially if a beta of a stock is greater than 1, then it's deemed that the stock is risky, or it's a risky stock to buy now, or it's a risky stock to hold for let's say the next 12 months. In this case, Google is 1.01, so it's a little bit just over the 1 that I like to be at. But since the PE ratio is slightly over 25 but not too much over 25, and the beta is slightly over 1 but not exceeding 1 massively, I don't mind these figures just because the moat of Google is so strong, and I'm willing to pay a little bit of a premium for it. But essentially for other companies where the moat might not be that strong, these figures, the PE ratio, the beta, and the dividend, are great benchmarks to understand in terms of whether a stock should be bought, should be waited for, or it should be left alone. So that's step 1. Essentially, step 1 will help you identify a stock from an industry, and it'll also help you filter out what a good stock or good company is from a lot of the bad ones. So I'll see you in step 2. So the second step is to go through the financial statements to see if the numbers reflect the full picture of that stock. So we typically do this to avoid any sort of pitfalls that could result in a long-term loss, because a lot of the trading that I personally like to do is long-term, because that's where majority of the wealth is accrued from. So I am here on the Alphabet Investors Relations page. Every public company that you ever will see that is trading on the stock market will have one of these pages. So I'm on the Alphabet page since that's what we're looking at. I've clicked on the earnings release and I have the Alphabet Q1 page here. So essentially what I'm first looking at here is Sundar Pichai, some of the information that he had given about that specific quarter. He mentions search was good, YouTube was good, cloud was good. First of all, from here I can see that it's very strong. So that leads me with positive expectations. Gemini is also doing very good. And then also AI, which is a buzzword that everybody likes to hear. They're really pushing AI research, LLM models, and a lot of AI innovation. So chatbots and various aspects like that. So the first page that I'm interested in is the balance sheet. So essentially a balance sheet is a company's report of their assets, their liabilities, and their shareholder equity at a specific point in time. So here I can see that for March 31, 2024, certain figures have gone up, certain figures have gone down. But you can see that they have assets, liabilities, and shareholders' equity. So assessing a financial statement typically takes a long period of time, but just to speed up this process, because as a beginner, you don't need to know what all of these terms mean. Accounts receivable, deferred income, goodwill, these are all terms that will not necessarily impact a stock's price. They're all good to know that, okay, taxes will be paid at a later time, they paid some money for charity, or just they had excess cash. But essentially, let's talk about some of the things that really matter, just so that you don't end up spending too much time analyzing various financial statements. So in this case, as of March 31, 2024, the total assets of the company are up about 1.2% year over year. The total liabilities of the company is down about 3.7 to 4% year over year, which is really good. And the company has enough cash on hand that will allow them to repay their total long-term debt, which is about $13.228 billion. And the cash here is about $25 billion. So essentially, this is decent for a company this size, typically because the bigger a company gets, the lower that you see revenues go up and liabilities go down. I'm quite satisfied with this. So in the next page, I will now look for an increase in revenues. Essentially, this is your consolidated statement of income. This will give you a complete idea on the money generation aspect of Google for that particular time period. So revenues here have gone up from 69 billion to 80 billion. Great. I'm all for that. That shows that the company is doing pretty well year over year. There's also an increase in net income, which is really good to see. So your net income is typically the profit that a company has, whereas your revenue is essentially the price of your products multiplied by the number of purchases that people have bought. So if I had a pen that I want to sell for $5 and one person paid for it, I essentially made $5 in revenue. And after paying all my taxes and all the cost of materials, let's say it costed me $2 to produce that pen after tax, tax and after all the material, I essentially made $3 in profit. So that's essentially what your revenues are. That's the revenue that you made, the price that you got, or the return that you got from selling your pen, which is here for Google, it's about $80 billion. And then your profit overall, which is that $3 multiplied by the number of purchases that you had, is essentially $23 billion. So you might want to slow down this video. I feel like I'm speaking really fast here. So you might just want to slow it down or pause it just to get an understanding of what I mean here. But essentially, these are really good signs, and it also tells you the overall profitability of a company as well. So revenues essentially are up about 15%. The net income is up about 57%, which is absolutely stunning for a company this size. It's incredible. And just to put this into perspective as well, most companies have a market cap that is greater than $1 billion. Their average profitability growth is about 10% on an annual basis, whereas Google had just blown this out of the water with about 57% annual growth. So that's great, just to see those figures as well. So that's essentially what I would look for here. Oh, sorry. So another element that I would like to take a look at before we just proceed to the next part of a financial statement is Class A, Class B, and Class C stocks. Essentially, within stocks, when you buy a share, there's three different types of shares that you can buy. You can buy a Class A share, a Class B, or Class C. Not all companies would have this distinction between stock shares, but Google does, and it's good to know what each one means as well. Your Class A typically are shares that will provide you ownership and voting rights on a stock, whereas your Class B have no voting rights, but it's typically just shares that can be distributed to the public. So these are essentially any shares that you can just purchase and make a return on, but you don't have any ownership rights that come with it. And your Class C shares, well, these are internal holdings that the company decides who gets to own them. So for example, if Google employees receive a stock bonus as a part of their compensation package, essentially Google will hold Class C shares and they will hand this out to Google employees or to investors of a specific nature, maybe banks or other financial institutions as well. So most companies don't have this, but it's just good to know that Google does. So in most cases, when you end up purchasing shares, you'll end up purchasing Class A or Class B shares, depending on what your broker provides. So that's just useful information. So hopefully that helps you out. Okay, so the next page that I'd like to take a look at is page 7, which is again, a part of your consolidated statements of cash flow. Essentially, your cash flow statement will give you an idea of the overall spend and the income that a company has generated using three different approaches, which is your operating activities, you have your investing activities, and you have your financing activities. So your operating activities are the amount of money that Google has generated based on its day-to-day operations, which is your ad business, your cloud business, the membership fees that they charge for that, the subscription that they get, the ad revenue for YouTube, and all that sort. So it's essentially the money that they are getting from performing the day-to-day activities. Your investing activities is slightly different. It's the money that you're getting as a return or whatever you're paying for the long term. So if Google paid, let's say, for property, $12 billion in property, that's something that they are looking to get a return on in the long term, maybe 3 years down the line, 5 years down the line. But this is still positive just because it shows that the company is investing for the long term. So this could essentially be them opening up a new office somewhere, potentially opening up new operations or extending leases to conduct their daily operations and so on and so forth. And lastly, you have your financing activities. Essentially, this is other forms of income that you get. So this is Google getting money from debt or Google paying out debt. It could be money from the stock market or repurchasing from the stock market shares and things of that sort. So essentially, financing activities is other forms of income, which is not from your regular operations or investing for the future. So based on this, as we had already discussed, net income is already there. But one key aspect that I normally like to take a look at is called the repurchases of stock. So when a company decides to purchase $15 billion of shares that are being publicly traded in the stock market for investors, this is a positive or bullish sign that the company is becoming more valuable. So let's think about this. If a company has less shares in circulation, it would naturally be more difficult for any new investor to purchase shares of this company. So when there's less shares, but more people wanting it, more demand, so that means it would naturally be more difficult for any new investor to purchase shares of this company, and in turn will make the shares of existing shareholders more valuable. So if I already hold Google stock before they had done their share repurchase program, so that means now my share has become more valuable because there's less shares shares circulating in the market. So overall, this is very positive. Another aspect that I forgot to mention real quick is within operating activities, I like to see the depreciation of property and equipment. So essentially, depreciation is when an asset is becoming less valuable the longer it is being used in terms of lifespan. Again, it depends on the nature of the company. For example, if I would have an automobile company, depreciation is going to be a very important factor for me to look at because I want to see how much inventory that the company is holding and the amount of depreciation or the loss in value that the company is getting for holding those assets for not being able to sell them. Since Alphabet is more service-based, I would assume the majority of this depreciation comes from their hardware side. So this isn't a worrying component for me, but if it was more of a product-based company, this figure would be quite essential to look through as well. So while you don't need to know everything in this statement, typically the net figures will give you a really good idea on how well a company is doing or how well it's not doing. So the net cash provided by operating activities here. So this is essentially the amount of money that the company has made from their day-to-day operations, as we had mentioned earlier. So this figure has grown year on year. So this is good to see. The investing activities had gone down year on year. Sorry, the investing activities had gone up year on year. Essentially, had gone from $2.9 billion to about $8.5 billion. So this money is being put to use in some of these areas. So that's also good to see that they're investing into the future and they're investing quite heavily. And lastly, in terms of financing, the financing aspect had also gone up year on year. So that means Google is going vigorously in terms of actually earning back or buying back more shares, which makes my existing shares more valuable. So that's also very positive to see as well. Essentially, that's how you would assess your cash flow statement. It's a really easy statement to understand if you're a beginner, but it's also a very important statement to understand as well. And just in case if you're wondering, and I didn't mention this, some figures are put in brackets, whereas some figures are not. So any figure that's put in bracket is essentially cash that is being paid out. And any figure that doesn't have the brackets is essentially cash that is flowing into the business. So whenever you see, let's say, the $19 billion here, that is essentially a 5.5% loss in cash. It's not exactly negative, but it's more of that cash is leaving the company rather than coming in. So that's also an important aspect that you should try and understand because this is universal across all financial statements. So essentially, this is a summary of some of these financial statements, but for me, I'm still not 100% satisfied because I want to know what the company is doing and I want to hear some of the information that Google is planning to do or has been doing. So I'm going to go back into the investors page. I'm going to click on PDF because I just want more information. Essentially, the Form 10Q is what is being filed to the Securities and Exchange Commission, which is the regulation body for stocks in the United States. So it essentially covers the same information. It's just the other file that we're taking a look at is more condensed, whereas this is more broad. But proceeding forward, for a company like Alphabet, adhering to the legislation is quite key. So I personally would like to read legal matters associated with the company. And that's normally, from my understanding, let's see how well I remember here, should be on page 23. Yes, which is legal matters. So normally I would go through pages 23 to 25 just to get an understanding on the amount of fines that they had, any regulations that I should be worried about, anything of that sort within the past 12 months. But in this case, in the interest of time, I'm going to do this in my spare time. But it's a good to know if anyone would like to purchase a tech company first, that you also have information about the legal matters, any antitrust issues. For example, they were imposed a 2.4 billion euro fine by the Executive Commission in 2017, and it looks like it's been carried out for a couple of years. In September 2023, we reached a settlement in principle with 50 state attorneys, and the U.S. District Court vacated the trial date with the state. So just information like this, for example, also Epic Games versus Google, which was a very huge lawsuit by Epic Games over their antitrust laws to Google Play, and a similar case was also filed between Epic Games and Apple for their App Store as well. So just for information on legal aspects like this, it's not going to majorly change our approach to investing, but you also want to know that this company is dealing with legal issues in the right way, because at the end of the day, all these companies, they're all liable to various courts, various authority bodies. So it's important that these guys are playing by the rules and they're not breaking any rules, because if they do, you end up getting a fine of $2 billion, just like Google had gotten a few years ago. So for a beginner that is reading a financial statement for the first time, this information is more than enough enough for you to understand whether a company is fundamentally good or not. Based on this information, it is your decision as to whether you believe the company is worth pursuing further or if you're not sold on their business models. So I personally like to read the whole financial statement just because it gives me complete clarity. But for further information as well, and to save you time, you can also attend the live webcast that every company holds for summarizing their financial statements as well. So that will save you a lot of time, and it saves you a lot of effort reading as well. So that it typically happens after an hour or two after the financial statements go live, which is typically after market hours. So that's something that you can look forward to as well. So with that being said, assuming that I would be interested in purchasing shares of Alphabet, let's now head on to the next step, which is essentially valuing the stock to see what price we should be paying for it ideally. So I will see you in the next step. So step 3 is valuation. So the valuation stage is a key component of investing that most novice investors typically tend to miss out on. So this step will help you understand the price that you should be paying for a stock, if the stock is currently overvalued or undervalued, and whether you should be paying a premium for the stock you decide to buy. So let's get into it. So essentially, this is my valuation sheet, and this is what I typically do for all the stocks that I want to understand what the right price might be to purchase. So I'm going to leave this for you in the description just so that you don't have to do it all by yourself. But I do want to talk you through it and kind of get you understanding what I've considered here and how I got to the figure. So essentially, if you recall earlier, we had visited the free cash flows as a part of an earlier step. So as a part of this step, however, we're looking to get the operating cash flows minus the maintenance capex is what we call it. So while we discussed what cash flows were earlier on, the maintenance capex is essentially the cost that is incurred to perform operating activities. So you're basically getting all the cash flow and you're subtracting all the expenses out of it. So whatever you have left, it's essentially the cash that you hold on to. So it's a positive figure. So for Google, to get this figure, the net cash and then the purchase of property, I've gone to the cash flow statement. The first figure that I need here is the total net cash provided by operating activities for 2024. So that's about $28 billion produced in the year of 2024 so far as of March 31. That's the first figure. The second figure that we require here is the maintenance capex, but most companies tend not to disclose this figure. So as a secondary figure, I'd like to take the purchase of property and equipment instead. So that here is about negative $12 billion for Google. So this is negative because Google spent $12 billion on new offices, equipment, servers, and other core activities. So since this is money flowing out rather than flowing in, this figure is negative. So using these two figures, we now subtract the cash outflow from the buildings, equipment, and other aspects with the cash inflow, which is the operating activities. And this will help us get our free cash flow figure. So that's about $16 billion here. And we're going to save this figure out for later. The next step that we need to do is we need to find out our discount rate. Now, we need to find out a rate that we think Google can increase its free cash flow by each year. This is essentially where valuation turns from a science into an art, as every investor has their unique perception of this growth. So to make my best guess of what this growth assumption figure would be, I go to a website called Guru Focus. I type in Google, I click on DCF here, and then I assess the past 3, 5, and 10-year EPS figures, the revenue, the EBITDA, and also the free cash flow as well. These metrics will typically encompass modern challenges that it would have taken Google to grow, but I prefer not to take, let's say, the 10-year because 10-year is very volatile. So Google could have had one amazing year 10 years ago, and that would have completely disrupted the figures that we see or that we would have taken for our analysis. So I don't really tend to take 3-year just because it encompasses more of the challenges that Google would have faced in order to generate some sort of growth. So to add more context, companies typically the size of Google grow at a very slow pace compared to, let's say, a small medium enterprise that would tend to grow a little bit faster. So that's why I typically take 3-year factors into consideration. So as we can see here, the EPS has grown by about 32.3%, the revenue has grown by 22.1%, the EBITDA by 19.6%, and then the free cash flow by 20.6%. So we can now plot these figures as a benchmark for our growth rate calculation. So based on these figures, I would like to take a conservative approach of probably about 20% here. So to reiterate my rationale, I find most companies grow at an average rate of 10%, but since Google's figures are quite robust, so I went with 20% as a solid conservative figure. But again, feel free to use any figure that you find best, but make sure that the figure you choose is quite realistic. Don't go with 100%, don't go with 80%. Those are very unrealistic figures. Typically 10% is really the average for multinational corporations, but Google's figures are quite robust, so I just had gone with 20% here. Okay, so step 3 now is to bring these cash flows to the present value. So we start out on year 0 and we built this out to year 10. So under year 0, you essentially just put in your free cash flow figure that you had gotten from earlier, and then we're going to apply the compound interest formula, which is essentially our figure multiplied by 1 plus our growth rate figure, which is of 20%. And then you lock it by adding the whole power of the number of year. So just to make it easier, you put in your B20, which is our free cash flow, into 1 plus 20% whole power the year. So this is year 1, this is year 2, and you essentially lock these figures of the free cash flow and the growth assumption, because these are going to be constant throughout your whole 10-year analysis. So I've done that for all of my years from year 1 to year 10. So essentially what we're doing here is we're predicting that Google will now be making $1.04 trillion in terms of free cash flow in 10 years time. So that's quite a realistic figure, I would say, considering that we're currently about 16 billion. So within 10 years, even if you assume that 16 billion is the main figure for the next, let's say 5 years even, you're already expecting about $80 billion. So $1 trillion is quite realistic. In my opinion, essentially that's what this 3-year cash flow will show you. So now since we got our 10th year cash flow, now we need to calculate our terminal value, or in other words, the valuation at which we think we can sell our investment in the 10th year. So to calculate this figure, I used a price to cash flow ratio from macro trends, as it would tell us the cash Alphabet will generate relative to its stock price. So I type in Alphabet. Once I open up macro trends, I select revenue, and then I go under the price to free cash flow ratio. So at the moment, if we can see here, the price to free cash flow ratio for Google, it's about 34.9, and this figure has remained stable for the past 8 years or so, anywhere between 20 to about 39. So just to be more conservative, I'm going to take a conservative figure of about 25 here. Now we're going to be using this figure for our calculation. So to get the terminal value, I now multiply our year 10 figure, which is $1 trillion, with our multiple of 25 to get a valuation of $2.6 trillion in 10 years. So this figure, again, isn't completely unrealistic if you observe that Microsoft, Nvidia, and Apple have recently achieved this figure this year, and Google is currently trading at about $2.1 trillion, as we can see here. Okay, there you go. As we can see here, it's about $2.1 trillion. So again, this figure is not unrealistic. To be honest, I foresee Google significantly exceeding this figure, but it's still a figure nonetheless for our calculation, since this is more of a conservative approach that we're taking. Okay, so that is our forecasted cash flows. The next thing we need to do is discount our forecasted cash flows to the present value. So we do this by applying a discount rate, or the rate we would like to earn from this investment. So my personal goal has always been to beat the S&P 500 in terms of micro trends. And currently the S&P 500, or for the past several decades, it's averaged about 12.5 or 10%. So my personal goal has always been to beat the S&P 500 market returns of 10% each year. However, in recent years, the index has averaged around about 12.5% per annum. So I would like to take a more conservative approach and take 12.5% as well for my discount rate. So using that discount rate to simplify our calculation of the present value free cash flow, I will be using a formula called the NPV formula. Essentially, the NPV formula will allow me to select the discount rate and then select all of our figures from our free cash flow from year 1 to year 10, and then you press enter. and you get a total about $2.4 billion here. And that is what our present value free cash flow is in terms of our estimated figures. And to get the terminal value using the same approach, you take your terminal value divided by 1 plus your discount rate whole power 10 for 10 years. And that comes about $8.02 billion as well. And if you add both of these figures up, you get your total present value, which is about $10 billion. So essentially what we have done now is we had calculated all of the free cash flow that Google or Alphabet had generated. But one additional step that I like to do is to subtract the net debt from our generating figures. Because as of till now, we've only calculated the amount of money Alphabet will make without really considering the debt that it will carry with it. So we will need to add the cash and cash equivalents figure and subtract all the liabilities from our calculation. So if we look back at Google's balance sheet, the cash and cash equivalents are about $24.493 billion, and the marketable securities are of about $84 billion as well. So on the same page, we can also get our total liabilities figure, which is about $114 billion as well. So plotting these figures in, we get a negative debt of about $6,000 or about $6.8 billion. So I will now add both of these figures, which is the present value of the total free cash flow, and then essentially add the net debt since we've already put a negative figure on it, and you get an intrinsic value of about $10 billion. Sorry, and that's $1.05 trillion, my mistake, but that's typically what I would now view as Alphabet's intrinsic value today. But just to clarify or just to simplify it further, I normally like to do one additional step, and that's a preference I like to do, and that is to calculate the intrinsic value on a per share basis. So according to Google's report, there are about 12.4 billion shares that are outstanding as of December 2023. Using this figure, if we divide the total intrinsic value divided by the shares outstanding, which is about 12.38 or 12.4 billion, you essentially get an intrinsic value per share of about $85. Now, many investors also use a margin of safety, assuming the majority of the figures that we have taken in this calculation process are assumptions. So to protect ourselves from overestimating certain figures, sometimes I like to assume a margin of safety that's between 30 to 50%. Here I've taken about 30%. I've also taken 30% of the total intrinsic value on a per share basis. Incorporating the 30%, I'd get a per share figure of about $60. Now, I know what you're wondering. This must be completely wrong because Google will never trade at this price. Because even if you take a look at Google's current price, it's almost double that. But this is where I like to bring some technical analysis into frame. So essentially what you see here is my technical analysis chart of Google that I've been updating for the past few years. So if you go back all the way to the year of 2021, you could see that Google had a fair value of what we had anticipated of about $84, and it had also reached its peak within the same year to about $150. So this is roughly about a 78% incline in share price. But also within the same year or the subsequent year, we see that Google had massively gone down as well, and that again touched our figure of about $84 as well, and that's a 43% decline. So when you roughly average this out, it's about a 35% gain that Google had during this entire process when you get the net gains figure. So to me, that makes a lot of sense because the figure that we had taken here was 20%, and that was more of a conservative figure that we had taken. But if you, for example, put in 25% as your growth assumption, you get a value of about 123. And if you put in 30%, which is roughly what Google had made, you got a figure of 177, which is what Google is currently trading at in 2024. And that's about 100% increase, which is absolutely crazy. But this is essentially the approach I like to take in terms of my investing, where I like to get my valuation, go through the technical charts, get an idea of what Google is currently doing or any company is currently doing in terms of whether my figures are quite realistic or not. So feel free to mess around with the valuation template to how you see best. For me as well, just to get this point completely across, I'd done another analysis for Apple using their financial figures, and you get a more accurate estimate. So similar to what we had done here, I had taken a conservative approach about 15%, which got me a figure of about 148. Pardon this is incorrect, but to about 148. And if I had taken, let's say, a figure about 20%, which is typically what I would have taken for Apple, you get a figure of about $209. And if you go back to our technical charts here, Apple is currently trading at $209. So I would now see Apple as fair value in this case because it's trading at a valuation that I'm quite comfortable with. Whereas if I had taken the 15% that we had generated here as a growth assumption, I would see around 150 as undervalued. I would see 210 as fair value, and I would then see 297 as overvalued. And that's essentially how a lot of your favorite YouTubers or a lot of your favorite investors typically get their undervalued, fair value, and overvalued figures and projections. So feel free to completely, as I said, play around with this. You're not going to get it the first time, but it's really good to keep on practicing the valuation process because it's essentially a key differentiator between how a novice investor trades to an expert investor. So that being said, let's move on to the next step, which is CEO research. Okay, so an additional step that is not mandatory but is useful to research is the CEO before you make your final decision. In this case, I essentially just open up a new tab. I type in, for example, since we're dealing with Google, I would type in Sundar Pichai and I just browse for news and various articles just for any reputational damage that could affect the company. So this is a unique pitfall that can occur if the fundamentals of a company are strong, but the CEO is not essentially equipped to take the company forward in the way that it should be. So this has happened to a few companies before. I'm not going to specifically name any of them, but you might have a great company. You might have the wrong CEO. The CEO has to step down within a year or two, and that really damages the shareholder value of that company. So I would essentially just go here. For example, there's a few podcasts that he does. I would listen in just to see what he's saying. If it's positive, if it's negative, I would then go through a few articles to see, okay, he's investing $2.3 billion in technology. There's a Google I/O he had done last month. There's a partnership of Google Gemini, which is quite positive as well with India because it has one of the biggest populations in the world. And essentially, I would just go through a few articles, a few videos and things like that just to see what he ends up doing. One other approach I also like to take is going through the LinkedIn profile of some of these famous CEOs. I'm sure they don't use their own LinkedIn anymore. They probably have someone to do it for them just because they're so busy. But essentially, by going through some of their experience or education and things like that, you get a better idea of their upbringing and it just helps you stay more connected. So I can't see all of this because I'm logged out, but if you log in, I'm sure you'll be able to see all of the experience that he had, some of the posts that he likes, what he ends up doing on LinkedIn, what he posts about, how people respond, because that's live feedback comment section. And you probably also get a more clarity in terms of his experience with Google and whether he's the right person or not to run that company. So this is typically how I would do my fundamental analysis. I know we've spoken a lot here and it's probably a lot of information, but again, you have access to the Patreon, you have access to my one-to-one calls and the group as well. So feel free to drop in any questions that you may have as a part of this course. But that's how I find winning stocks, how I read financial statements, how I decide what price I'm going to buy and if it's overvalued, undervalued, or fair value. And then that's how I research my CEOs as a last prerequisite before I decide to pull the trigger on a company. As a quick note as well, sometimes I end up paying premiums for certain companies depending on the nature of the company and how big the company is. So sometimes you might want to factor that in as well. If a company is really good and you have a positive inkling that the company is going to do really well in the next few years or any information of that sort, sometimes you might end up paying a premium. But in most cases, whenever a company goes up, at some point it will always come down. So you either wait for the company to come down and you buy, or you buy while the company is still going up so that you can also get a piece of that share and that return as well. So those are the two approaches that I would consider. Again, if you have any questions, feel free to drop them down in the Patreon community, and hopefully this has been very insightful. So I'm now going to go into the two bonus modules that I have for you. So I will see you in the next one. Okay, folks, so this is essentially a bonus module on how I would start investing. And this is just as a thank you for taking up the course. So I wanted to share a more personalized approach, which is not theoretical as we were discussing earlier on. So now that you're aware of my approach to investing, it's time to start making the money on your own. To make this process easier, here's how I would allocate my budget to fit my investing needs. In personal finance, I often teach the 50-30-20 rule of investing to majority of my clients. Essentially, if you're new to that rule, which I'm sure most of you are not, but 50% of your overall salary is allocated to needs. These are essentially your must-haves that you need to pay to survive. So that would include your food, rent, transport, etc. The 30% is allocated to your wants, which is essentially your trips, your expenses like your shopping bills and the new shoes, your concerts and all that, which are not a necessity, but those are what you would want to do. And the remainder 20% is allocated to your investments. That is your stocks, real estate, business, or even just investing into yourself as a human being. This is essentially the 50-30-20 rule that I teach majority of my clients. And while it's quite easy to tell someone to do, let's say, the same thing as me, I typically don't do that. As a Gen Z investor, I often see my fellow generation avoid using their 20s to set up their 30s, their 40s, and so on and so forth. Everybody just wants to live in the moment and want to spend as much as possible without taking the responsibility or accountability of those decisions later on. And that's something I personally won't be doing. I don't need the 50-30-20 rule to discipline myself just because I know that by saving now, there's a greater goal that I'm trying to reach, which is financial freedom. This might be you as well, and this is kind of the message I want to put through this module. It is detrimental to both your personal financials as well as your investments if you end up spending more and saving or investing less, because the longer you are in the investment market, the more money you can make long term. Therefore, if I were you, I would slightly modify the 50-30-20 rule and end up with a different approach that will allow me to invest more than spending more. So I just want to show you here my budget. This is my Notion budget. It's free for everyone to access. And it's essentially a discipline tracker that I like to use when teaching my clients the best way possible to use every single dollar that you have left in your bank account. So for example, here you have your total balance, you have your total expenses and the remaining balance that you have. We also have a section for your income. We have a section for your expenses, essentially a summary of all of your expenses, which is a summary board. That's quite easy to make within Notion. So essentially, I personally would allocate about 50% of my salary to pay my bills. And I'm going to take the assumption here that the average European or the average American or whichever country you're from, I'm going to take the average estimate of a salary of about $2,500. And let's try and put this perspective into practice. So as you can see here, I've taken the assumption of us working a 9 to 5 and we make about $2,500 on a monthly basis. And this is a fixed income. Some of you may have other extra incomes, which I always recommend you do, whether it's as simple as teaching or like tuition for someone else, all the way to maybe becoming a social media influencer, becoming a podcaster, becoming a sports coach, anything of that sort. Any additional income is always going to be beneficial for your investments. So assuming that I normally allocate 50% of my salary to paying my bills, we can see here that I'm massively overweight. About 80% of my overall salary is going into my expenses, which only leaves me about $460 to invest, which will not be beneficial long term. It's going to take a lot longer for me to reach my investment goals or my financial freedom goals. So we got to change this up a little bit. I'm going to try and push this down to about $1,250. And to do that, we need to make slight modifications as well. So if you live in Dublin or a country as expensive as Dublin, this figure is naturally going to be quite realistic to you. I'm going to assume that we can slightly reduce our rent figure down. Some people can't, which is completely fine. You're going to have to find other places to compromise. I'm going to show you my personal case of what I pay and how I kind of maneuver my investment portfolio in terms of my income. So for me, I normally pay about €900. Let's just assume €1 is $1 here. I have no loans that I have to pay just because loans are such a scam and I am never going to take any loan that's going to take money out of my pocket. Rather, I take loans that would put money in my pocket, but that's a different story. I have no subscriptions. I don't pay for any subscriptions just because it's so easy to forget. I do use free trials. For example, I'm recording this on Loom. I'm using a free trial. I'm not paying for it, but I'm going to try and record this whole course within 14 days and then I will get rid of Loom after because I'm not going to pay for that. So it's It's working smart. You can call me a cheapskate, but it's working smart. So it is what it is. Groceries, I normally allocate about $250. Well, normally I have about $200, but sometimes I like to have cheap meals and things like that. So I'm going to allocate about $250 to that. One good hack for reducing a grocery bill is not eating out that much, not going out to restaurants too much, and to start using a gym diet, because typically your gym diet is relatively cheaper than going out and buying food, and it's also better for your health. And you can also meal prep, which is essentially what I do. I like to cook once, store it for about 4 days, and then I recycle that entire process. Not the food, I recycle the process. So that's essentially my approach in terms of utilizing my money. In terms of utilities, I do have a phone bill that I have to pay. That's about €15, 1.5. And then I also do have an Apple Cloud subscription, which is about €1. So I don't really spend too much on utilities. My rent is inclusive of all my bills. So I don't really pay a separate electricity bill, a separate water bill, and all that jazz. When I negotiated my rent, I negotiated with all my bills inclusive so that this figure won't fluctuate up and down, and it instead a fixed figure. So I have about $16 for my phone bill and then my Apple Cloud bill, which is like €1. And then in terms of entertainment, I only really spend when I travel. I don't do much for entertainment. I like to spend time with my friends and my family and people like that. So you can call me a buzzkill a little bit, but I don't spend too much, but I do like to allocate maybe about $50 often when I want to go out. I don't drink, I don't smoke, I don't do any of that stuff. So I don't typically have a bill that's quite high, because especially in Dublin, drinks are quite expensive. So naturally that'll bring my bill down. And yeah, if that's something you can do in terms of removing excess entertainment to push your bill down, that'd be good as well. So essentially this is my budget. As you can see, we brought it down all the way from $2,000 all the way down to $1,250. And this is essentially how I kind of work my monthly budget. So I normally allocate about 50% of my salary to my bills. For example, I make about $2,500 a month. That would roughly be about €1,250. That would go into my expenses. Next is my needs. So normally what I do here is I like to keep my needs below my means, if that makes sense. And this is essentially a good problem to have, because when your needs are the bare minimum and you don't really go outside of your transport, your food, and then your rent, essentially you have a very healthy problem in terms of putting additional money into your investments. So I typically only have those three as my necessities. I don't really go outside of my bills and then a little bit of leisure here and there. I don't really go outside of that. It's essentially delayed gratification. So something I would highly recommend to most people, and it's a much better lifestyle than splashing out cash and then living paycheck. So those are essentially my needs. And just to touch upon wants, your wants are essentially the biggest destroyer of wealth building. By keeping yourself disciplined and delaying instant gratification, you can end up making more money later on than right now. So if you want to reduce your wants to about 10% of your total income or lower, you are essentially putting yourself in a position to thrive later on in your life. So as you can see here, my wants are essentially a little bit of entertainment and probably a little bit of travel here and there. Not too much. I don't travel often, but that's essentially all the wants I really need. So keeping that in mind, I now have about 40% of my income that can now be invested into stocks. And just to summarize how we got that 40%, 100% is our total figure that we have, or our paycheck, but 50% of that goes into your expenses, 10% goes into basically your wants. If you're going to include that figure into, we're going to separate that figure. Since I've included it, it's essentially 50%. That are my expenses and my wants. So I have about 50%. So essentially now I have about 50% of my income that I have left to invest. So that would essentially mean I have about $1,250 or €1,250, assuming they're both equivalent, which is ready to be invested into stocks or any other aspect that's going to build my wealth long term. So for most individuals, normally when you invest into stocks, there's again different approaches that we're talking about. But for most beginners, using the dollar cost average method to put your money into a select few large cap stocks is certainly the way to go. These large cap stocks provide minimal risk and can compound at about 10% per year. So if you find picking out stocks is time intensive or difficult, index funds are also the next best option. So index funds are typically public, and the owners of these funds publicly display their past 3-year returns. So you can easily find these on Google for your country country, and choosing the one that suits you best and then DCAing into that fund will help you long term get the return rate that you foresee and will build wealth long term. And whatever you do, ensure you always invest with capital and you don't invest with leverage or debt, as this can massively deter you away from your investment goals. I've seen a lot of people invest with debt, a lot of people do day trading, swing trading, all sorts of trading, and it can really burn you long term as well. So it's not the most accurate or the most appropriate approach to take, especially when you're starting off. And just as well, I wanted to touch on boosting your returns. If you can always get a side hustle or second job, do it. That's for two reasons. One, it's going to increase the amount of money you can invest without really compromising your lifestyle. If that's something that you want to do and you feel like utilizing or reducing your expenses is too difficult, we all have to make sacrifices, and I'm glad I made mine because now my portfolio is doing very well, as you saw earlier in this course. But you have to make certain compromises, and if you can't, just make more money, and that will help reduce at least some of that stigma or the FOMO that you might have from reducing expenses. But also the second approach is that relying always on one 9-to-5 job is never going to be sufficient to building financial freedom. You always need to have a second, third, and fourth source of income. It's very hard even for any self-made millionaires to become a millionaire using one job. They always have a second job or third job or some sort of multiple figure income that comes in every single month for them to even reach that significant figure. So you don't want to always just end up relying on one job. You don't know whether market conditions will affect that one job, and you might be jobless at one point. So it's always good to start a side hustle. Do it under the radar. You don't need to really tell anyone. Make sure that you bring it up to monetization. Make sure you're getting a really good income from it by growing it out in months and years and so on and so forth. And at some point, when that job pays you roughly about 4 to 5 times your annual salary that you make in your 9-to-5, that's when you know that, okay, I now need to make a decision on whether I should be doing that side hustle full time or I should be still doing 2 jobs at once. So that's essentially how most millionaires become millionaires, or their thought process. You try and mitigate the risk as much as possible in this process. And this is essentially how most people do it. And most millionaires that I personally know do it. And this has been ingrained in me since I was 18. So I've been practicing this for the past 4 or 5 years as well. And it's essentially how I'm building my wealth. So whatever you do, ensure that your needs are met and your investments are the second priority more than your wants. If you struggle with prioritizing investments and need tailored support, I mean, you have my exclusive community, and let me know. I'll try and drive these results for you. But essentially, delayed gratification is the success secret that most millionaires don't tell you. This is how I would do it. This is how I would now invest. You already know my approach to how I would find stocks and how would I invest with them. It's essentially about now having the money available for you to apply that approach. So you might not like all of this now, but please follow this. Failure is not an option, guys. When you're dealing with money building, it's unacceptable to be broke when it's so easy to make money out there. You might not like what I'm saying now, but if you practice, put all of this into your mind and start implementing it, telling yourself that spending outside is bad, it's only going to do harm for long term, and you start tweaking your perspective on certain aspects of your spending, it certainly will do benefit for you. So as I said, you might not like it now, but you will certainly thank me later. Thank you, folks, for making it this far into the course. As we approach the final module in this course, let's talk about an unpopular topic that no one really likes talking about, and that's essentially paying your taxes. So based on where you live, your taxes for stocks will look very different. For example, in America, your tax rate is based on your household and your marriage status, and this figure can range anywhere between 10 to 37%. And similar in Europe, capital gains tax is a tax that we personally pay once your returns exceeds a certain threshold. There is an approach called tax harvesting, which is essentially you selling some of your stocks for a loss, so you reduce the amount of tax that you pay on it. But again, I'm not a financial advisor nor a tax consultant. I'm just an accountant, so that's not exactly what I deal with. But please ensure that you are legally abiding by the law and you are declaring your investment taxes on your gains. Hello, you made it to the end of the course. Thank you so much for being a valuable supporter of the Wealth Whisperer family, and I hope I was able to help you start or improve your investment journey. For additional support, feel free to join my close community where you will get access to me on a daily basis for your investment needs. For any other personal finance queries or feedback on this course, please feel free to reach out to me on LinkedIn. With that being said, I would like to thank you once again for your support, and I hope to see you at the top. That's me, Sandesh Barada, signing out.